So let me start by being fair to the software solutions that are out there. These tools are genuinely very useful in a few areas. They're fast, they're pretty organized, and they can pull financial data together fairly quickly, and they can ask some baseline questions so that you can get a rough estimate much faster than doing everything manually. So for an experienced founder or finance lead, you can absolutely do this, and it's going to be extremely helpful. It can save you time and can give you a good starting point for where the credit could potentially be. I don't want to pretend that these tools have no value at all, because they really essentially do. One area that they do fall a little bit short, though, is that they just give you a number, but they don't explain why those costs belong in the R&D credit claim at all. And look, that can be a really big issue, especially going forward, because what the IRS is ultimately moving towards is that they don't want to see just a final number. They want to see that bridge from the number back to the actual work. They want to understand what business components are being claimed, what technical issues and uncertainties they had, and what were the experimentation process that took place, and ultimately, how were the wages and the percentages derived. And those source records support the position that ultimately goes on the tax return. So that's really what separates a simple software generated output from a complete holistic credit study. A real study is not just a finished form with a few numbers on it. Really, it should include the completed forms, of course, yes, but also say a credit summary, a methodology memo, and say documentation and narratives that connects the projects, the technical challenges, and just ties everything together in a way that someone, maybe an IRS agent, can follow later. So I think a lot of founders know this sort of intuitively. They open up one of these reports, and on the surface, it looks extremely polished, right? The number looks clean and the form looks nice. But if somebody challenged this, where these numbers came from, I don't know how I would defend a single line on the form. And look, you're absolutely correct. And as the IRS moves more towards business component level reporting and that detail that's going to be on the new Form 6765, that distinction becomes even more important as we look forward into the future. So if your output only gives you, say, just a number, but doesn't explain the story, the why and the how behind it, your instincts are very much on point, and that, kind of tingly, spidey sense feeling that you're having is really kind of telling you something. Quick aside, while we have that distinction fresh in mind, if your PDF tax form didn't come with a methodology memo and additional supporting documentation behind it, and maybe you just want a second set of eyes on it, there's a link in the description below. We can connect and we can talk through it together. But let's go ahead and talk about these different areas and the automated tools, what they can really do, and also what they can't do so well. And one specific area I do want to talk about is the reading of contracts. Okay, so let's use a simple example. Say you have a small US software company using this AI or software platform. The tool roughly sees about $100,000 of contract spend. Now, it takes that line at face value. It may ask you a few high-level questions, maybe classify it as potentially qualified, and then it's going to move on. But when you look at the facts and read closely and you connect it to what's happening in real life, the picture that can change depending on the fact pattern. So first of all, the contractor costs are not usually counted just dollar for dollar. We've talked about this before in other videos. If the work is otherwise qualified, you're generally looking at a 65% of the total expenses. So that's the first adjustment that needs to take into consideration. But even before you get there, you still have other questions that you need to work through. Where was the work physically performed? What exactly was the contractor doing? Did your company retain the rights, and did you have all the risk to the work product that was done? These aren't simple side questions or issues that you can ask later on. Those questions can completely change the narrative, whether those costs get included in the study or they get excluded entirely. Sometimes it's a little bit of both. Maybe you pull the SOW and the MSA, and at first glance, the vendor looks like it's US based, right? The invoice has a US address and the company is headquartered in the United States. So look, everything looks fine on the surface, but when you start to dig a little deeper and read closely, or maybe you know that, hey, you have to talk to the folks that really work with them side by side, and then you realize, oh, they staff the project with offshore contingent workers. All of a sudden, something that used to be a slam dunk, it doesn't look so great anymore. Look, my point is that you can't just stop at the address that's on the invoice. You have to ask the individuals that are doing the work, where are they physically located? Because the invoice may come with a US entity or US address, but the work that's physically being done may be happening outside of the US. That's just one area. Let's keep going. So maybe you keep reading and discover that one of the statements of work is really customer funded. That means the customer owns what was built. The customer carried the risk and your company just delivered the result. But did you really own the underlying development that the way the credit requires you to? Or was this something owned by the customer? Again, this is not something that the output is going to catch. Even if you have a sophisticated AI model trying to interpret the nuances of the contract, doesn't know when to stop and say, hey, look, something doesn't really add up here. I think I need to talk to somebody and talk with the folks that are on the ground doing the work to walk me through how the contract is being executed in reality. We all know how much AI models want to please us and give us the answer that we want. So are we sure it's not just producing the answer that it thinks we want? And what if it's wrong? The IRS doesn't accept, well, the AI model said it was. That's not a defensible excuse. And that's why I keep saying a simple number on a form is not the same thing as a defensible credit claim. The number may be super neat and super clean, but we all know the facts are sometimes not that way, especially when we're talking about business, people, and real life. Harping back to the new Form 6765 that I've talked about so much, it continues to evolve and keep moving forward to this business component level support. The IRS increasingly wants to see that detail behind it, and before anybody comes for an audit, they want to see that on the form itself. If you run a hybrid team, or if you used outside developers, or if you have a lot of contract-based work, this is one of those areas where understanding the details of the work are going to be extremely crucial. Look, if that walkthrough made you go and reread your own SOWs and credit report tonight, yay, fun reading material before you go to bed. But look, if you want some company and you want someone to help you with it, there's a link below in the description. We can jump on a call and we can talk through it together. Stick with me here because we're going to get into, say, 5 ownership questions that I want you to go through so that you can understand this in a little bit more detail, right? These are the questions I would run against any generated output, maybe AI or software generated, before I let it anywhere near a tax return. Okay, so let's go ahead and get into it, because once you ask these questions, you're going to start seeing pretty quickly whether you're holding just a extremely rough estimate that was generated by an AI model or software, or maybe you have a genuine claim that is being built in the right way. Okay, so let's start with question number 1. Who is mapping the specific business components, right? And is there a clean nexus from, say, the GL or general ledger to, say, the payroll and also the supporting documents? And are they backed up by each one of those things? So saying we built a platform is not a business component. That's a general broad label. Inside that one label, there's going to be multiple components, multiple technical challenges and issues, and probably multiple categories of work. Now, if no one has broken that apart into individual components, then the claim is usually still too broad to trust completely. Okay, so that's question number 1. Now, let's talk about question number 2. Who reviewed how the wage percentages were derived, including direct research, supervision, and support? This is extremely nuanced, and this is where things often get quite messy. A lot of claims look clean until you ask where the qualified percentages came from. Was it tied back to a specific component and the actual work, or did someone just apply a, say, top-down estimate because it felt, directionally correct, or sort of a peanut butter spread? And look, this is also where I want to be careful and accurate, because people sometimes oversimplify things, and also there's a recent case law talking about this as well. Coming out of cases like Little Sandy Coal and the way the IRS approached these claims, the big lesson is not there is one rigid wage formula everyone must fit into. The lesson is more along the lines of that business component has to be tightly defined, and the support has to be good enough that the qualified research story is believable and supportable at that business component level. If you're looking at a claim and it has a very, say, even, polished split across direct research, supervision, and support, and there's no real explanation behind it, that could be a potential flag for you to pause and take a deeper look. Not because every ratio has to look a certain specific way, but ultimately we want to see that those overtly clean allocations, those peanut butter spread allocations, those are the ones oftentimes get scrutinized because it doesn't tie back to the work that was done. So sometimes the right answer is to shrink back. Now, I've talked about this in previous videos where you don't want to look at the whole platform itself, you want to pare it down into its narrowly defined parts. And once you do that, it makes the support file so much cleaner and it makes sense within what the IRS rules say. Let's talk about question 3. Who reviewed the contractor offshore and funded work for the risk, rights, and location? Now, you already saw why this is a big area of concern in the example that we just went through earlier in the video. And this is exactly the type of thing a clean output or a AI generated output can miss, because the output is usually reading, say, totals, not contractor language and factual nuances. Now, I know these new AI models do a pretty decent job of that, but are they going to be asking the right questions? Are they comparing it back to real life activities? And ultimately, that's why I want somebody in the loop asking these questions. That's why I grouped these first 3 questions together. They all go back to the same issue. Who is owning the detailed review behind the numbers and the credit process? Here's my honest recommendation. If you can't explain today how your business components were mapped, say how your wage percentages were derived, or how your contractor and offshore facts were reviewed, that's exactly the kind of thing you would want looked at before your tax filing. If you want to look that through together, there's a link below and we can definitely jump on a call and I'm happy to walk you through it. Now, let's keep moving forward, and that brings us to the last 2 questions. Question number 4, who is coordinating with your CPA so that the credit lands on the filed tax return in the right way? Now, this sounds super basic, but it's a real world problem that nobody really talks about. Somebody has to own the process from we generated a credit to this is what was claimed correctly on the tax return and everything was filed properly within the deadlines, and this is, say, hey, maybe the payroll tax refund that we're going to get. Look, I understand this is extremely basic, but ensuring that all the forms are complete, the supporting logic is understood, and then also, again, if you're a startup, using the payroll offset and the election was made correctly, all of that is extremely important. I've seen companies use a software or AI generated form and then just assume that it was done. But then they only found out later that the claim never made it onto the tax return the way that they thought it did. So that's my point here. A form with numbers on it is ultimately just an empty claim if it wasn't properly filed and supported. So let's move on to the last question, question number 5. And depending on your company, this may be the most important one, but ultimately, who bears the responsibility if questions come up later? No, I want you to think about that. If you used a software or a AI generated output, does the AI bear the responsibility? Because the AI and the software isn't, right? Someone or somebody has to own it. Somebody has to explain the methodology, and someone has to answer if the IRS asks how the number was put together. Someone has to be in the position to say, here's why these costs belong in the claim, and this is how we did it. If no one has that clear responsibility, even before you file, it usually becomes extremely difficult later on to assign that to someone. Rebuilding that support a year or even years after the fact is always going to be extremely difficult. It's going to be slower, and ultimately it's going to be a weaker claim because that's not how the IRS wants to see things done. Here's what I'm going to leave you with. Run these 5 questions against whatever you're currently doing, and if you have a clean, all US-based W-2 team, and maybe there are clear business components and straightforward facts, and there's a qualified person who's in the loop and owns and supports the file, then maybe a software plus a CPA is absolutely enough for what you're trying to achieve. But once you start layering, say, contractors, offshore work, funded projects, maybe fuzzy wage percentages, and less of a broad, we just built this generic platform, and say you don't have real business components you can tie it to, I would strongly consider getting that claim reviewed before you file your taxes. Either way, I want you to remember the distinction we started with. The software and AI solutions can be extremely useful tool, but the judgment and the ownership is ultimately the legs that your claim is going to stand on. Quick note before we wrap up. Everything that I covered today is for educational purposes only, and it's based on how the R&D tax credit generally works. Look, every company's situation is going to be different, and the exact amounts depend on your specific fact pattern and your situation. This isn't individual tax advice for you and your company, so I want you to please check with your own tax advisor and CPA for your specific situation. And in addition to that, these 5 questions pair really well with my 7 flag pre-filing checklist video. So if this topic is really on your mind, that's a good one to check out next. So again, appreciate you watching, and I will see you in the next one.